Welcome to Finside Updates YouTube channel. Let us discuss Index 103, the key difference between business combination and asset acquisition. Paragraph B5 to B12 provides guidance on identifying a business combination and the definition of a business. Key differences between business combination and asset acquisition. Measurement basis. Assets and liabilities are measured at fair value. Assets are recorded at cost and allocated based on relative fair values. Goodwill recognition. Goodwill may be recognized if purchase price exceeds net fair value of assets. No goodwill is recognized. Purchase gain recognized as a gain in capital reserve if net asset exceeds purchase price. No gain. Excess is allocated to cost acquired. Transaction cost. Expensed as incurred, capitalized as part of asset cost. Contingent consideration recognized at fair value on acquisition date, generally not recognized unless probable and estimate. Intangible asset identified and measured separately from goodwill, only recognized if they meet criteria for asset recognition. TUPE transfer of undertaking, protection of employment regulation to be complied in case of business combination. However, it is not required in case of asset acquisition. Conceptual difference. Business combination acquiring control of a business, an integrated set of activities and assets capable of generating returns. Asset acquisition, buying specific assets, example gratia, equipment, property, IP, without acquiring a full business. Example, buying a company with staffs, systems and operations is equal to business. Combination, buying a factory building and machinery only is asset acquisition. Core, core elements required: input, process and output. Input means resource such as assets, that is intellectual property, equipment, employee that are used in a process. Processes, systems, standards, protocols or workforce that can convert into that can convert inputs into outputs. These don't have to be fully developed or documented, but they must be substantiated. Output are not strictly required, but the set must be capable of producing outputs such as goods, services, or investment income. 5 steps of concentration test, which is very optional to identify the acquisition is a business combination or asset acquisition as per Index 103. Step 1. Identify the gross assets acquired. It includes all assets acquired, excludes cash and deferred tax or liabilities, excludes certain items, remove goodwill resulting from deferred tax liabilities and any liabilities that are not part of the gross assets. Determine the fair value of each asset. Measure the fair value of identifiable assets, example gratia, land, building and IP and inventory. Assess the concentration. Check if substantially all of the fair value is concentrated in a single identifiable asset or a group of similar assets. Make the determination. If concentration exists, the set is not a business. If not, proceed to business assessment framework, input plus processes. Example, If a company acquires a portfolio of real estate properties and 95% of fair value is in one building, the test may conclude it is not a business, just an asset acquisition. Would you like help applying this test to a real or hypothetical transaction? Other examples. Absolutely. Here are a few realistic examples how the concentration test is applied to determine whether an acquisition is a business combination or an asset acquisition. Example 1, a real estate portfolio scenario. A company acquires a portfolio of 5 buildings. Fair value breakdown, one building is equal to 9 crore, remaining 4 building is rupees 10 crore total. Analysis, since 90% of fair value is concentrated in one identifiable asset, the concentration test is met. Conclusion, this is not a business, it is an asset acquisition. Example 2, mining operation. Scenario, a company acquires a mining site with equipment and rights. Fair value breakdown, mining rights of rupees 1.4 crore, equipment of rupees 0.1 crore. Analysis, the total fair value is 1.5 crore and 93% is in the mining rights. Conclusion, the concentration test is met. This is an asset acquisition, not a business. Example 3, pharmaceutical IP acquisition. Scenario, a company acquires a patent for a drug and a small team of researchers. Fair value breakdown, patent is equal to 5 rupees 550 crore, workforce and lab of rupees 5 crore. Analysis, patent accounts for 91% of the fair value. Conclusion, the concentration test is met. This is not a business. What makes a process substantive? A process is considered substantive if it meets these criteria. It is critical to converting inputs into outputs. For example, manufacturing protocols, intellectual property development, or customer service systems. It includes an organized workforce, employees with the necessary skills, knowledge, or experience to perform the processes. It is not merely incidental or administrative. Routine tasks like bookkeeping or payroll alone don't qualify. Two scenarios to assess substantiveness with outputs. If the acquired set produces outputs, the process is substantive if it includes a workforce that performs research and development, production, or service delivery, or it includes intellectual property or systems that drive output creation. Without outputs, if the set does not yet produce output, example Gratia, a startup in a development, the process is substantive only if there is a workforce with relevant expertise and the process is directed toward creating output in future. Determining the strategic fit for growth. Decision to grow through acquisition should always be in line with the company's strategic vision. When considering an asset purchase, management aims to bolster specific areas of operation or fill gaps in their existing asset line. If goal if the goal includes broadening the product portfolio or expanding into new market territories swiftly, a business combination may prove more beneficial. I hope this video is useful. Thank you.